Welcome to the Wiser Wealth Management Roundtable, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Hi, Brad.
Hi, Casey.
Hi, Matthews.
How's it going?
So today's podcast is an interview with Mary Ansley Southerland of W.D. Little Company. Her company provides mortgages. She's, I guess, what we call in the Wiser approved list of referrals. As we know, we are not proponents of having a mortgage. We prefer you'd be financially independent with no mortgage, especially in retirement. But most of us don't get to live that way. So mortgages are something that we all need at some point.
Being mortgage-free is an aspiration that we can help you achieve.
Absolutely.
I think it's something that's important, though, and is in the news a lot now. Hot topic being with the lower interest rates, people learning about mortgages or refis is kind of an important topic right now.
Yeah, absolutely. Absolutely. Mary Ansley, I learned something about her today. Her family's been a part of Marietta since 1852. So that's a long time.
That's a very long time.
And she didn't mention this, but I believe she had a family member that was a mayor of Marietta at one point. So anyway, it was an honor to have her today. And here's our interview with Mary Ansley Southerland. And with me today is Mary Ansley Southerland of W.D. Little Mortgage. Mary Ansley, welcome.
Thank you. Happy to be with you.
We've known each other for a few years through Marietta Rotary. This year, you are the Rotary president. Is that correct? In this
officially
COVID environment?
3 weeks and counting.
But we're here today to talk about mortgages. And you are, we'll call you the Wiser Wealth Management endorsed mortgage provider for our clients. We've shared many different families over the last year or so. And I just wanted to bring you on today to talk about the current mortgage environment. I will say for our listeners that I like no mortgage. We talked about that offline here a minute ago, very much of the Dave Ramsey approach of being debt-free, especially in retirement. But for most of us, we don't get to have no mortgage.
It's kind of a necessary evil.
That's right.
Some people like to have a house to live in.
That's theirs.
Correct.
Right? Because we could rent. That creates different issues as far as building wealth. But let's start off talking about just mortgage interest rates. So I think we had a client recently get, was it 2.8% over 15 years?
Probably in the 2.8 range.
Yeah.
And we're now even touching 2.5%. So, and again, there's a lot of factors that go into determining that final interest rate. It's impacted by credit scores, your equity position in your property, and a few other things, and a customer's choice on how they handle some of the costs and fees with the loan.
Well, let's start with that right away. When you go out to get a mortgage, people think that they walk down to their local bank and they're going to get a mortgage from that bank, and that bank will send them a bill every month and they're going to pay it. And when they pay it off early, they go to the same bank and they got it paid off, or they want to refi the mortgage, they go to the bank. What's really happening in the background with mortgages? Kind of walk me through the process of a mortgage.
I always encourage people to go back and look at history. And history will tell you that back in the 1960s and 1970s, we had a crisis in this country where banks were lending money for the long term. And then no economics system maintains for the long term, like 30 years. So the banks were in trouble back then. They had taken on deposits that they were paying out more than they were making on the loans that they were making. So the government stepped in, created this lovely system that we have now called the secondary mortgage market. And that creates liquidity in our marketplace. So when you walk into a bank, you will probably get a nice business loan or a car loan or maybe a real estate loan, but probably 10 years, maybe 15 years. They're not going to tie up their money that long. So what the government did to support the housing market is in the late 70s, early 80s, really support this marketplace where people are investing their money to make money, and we're using it to lend to people to buy homes, and it keeps money flowing in a circle. Where it gets confusing is that banks may temporarily fund this loan in the middle. Once we get you to the closing table and before it actually gets back to the investor who's going to make the money on the money they're lending to you, that money is funded temporarily through a bank. But banks do the same thing we do. Banks package it up, sell it, recycle it. They do not hold those loans on their books for the long term.
So let's talk about mortgage costs. You see on TV the no closing fee mortgage or the no or the low. How is all that? I kind of see it as a shell game.
Very much so. I think everybody's mama, grandmama told them nothing's free. Really? It's true. Very true. It's my job to put my client in the right loan, and the right loan being the right interest rate for them and the correct cost structure. There are costs with every loan that do not go away. It's how we get them paid. You can pay them in cash. You can add it to the bottom line at closing. We can, on a purchase transaction, ask the seller to pay those costs for you, or we can embed them into the interest rate on the loan. And that's what you're seeing on the flashy television commercials. I won't say which ones,
right.
But typically, because what you do when you call a 1-800 number on television, you're calling into a call center, and those are just pre-screening. They're going to say, hey, let me run your credit report. Let me find out what your credit score is. And here is this, so we don't have to think about it. Here's your 3% loan.
Right.
And it's no cost. When you call me, we're going to discuss your goals in life, how long you're going to live in your house, how long you think you're going to hold this loan. What's Casey helping you with your retirement planning? You know, we have enough money for the kids to go to college. And I always tell my clients, if you've got kids and you think you have enough money, you don't. So just keep working on that.
Right.
And let us work on this piece over here. But we're going to look at the 2.5% rate. We're going to look at the 2.625, 2.75, 2.875 to make sure that the client gets the best deal for their situation, not just the no-brainer, because the no-brainer is not what we're about. That's not how we've stayed in business for multi-generations. You know, we really, really pride ourselves on helping our clients make good choices.
So the 2.5 rate, you're probably coming out of pocket and writing a check at closing.
Correct. Or on a refinance, the typical transaction rolls those costs back into the loan amount. For instance, if your payoff on your existing loan is $200,000 and your transaction costs are $5,000, then you end up with a new loan for $205,000.
Right. Where on a new mortgage, you would just pay a higher rate.
Potentially, or the seller can contribute towards that. Or again, we can embed them in the interest rate. And there's a payback period. When you look at $5,000 amortized in a mortgage payment, it's not 0.5% on this range is, $30 a month, maybe $25 a month. So payback on paying costs up front is going to be a considerable amount of time in the future. 5 years or so.
Yeah.
When it gets to be 7 years, that's when we take pause and say, is it really worth this? What are your opportunity costs and uses of that money now?
Right.
Rather than spending it today to save $30 a month over the next 7 years before you recoup it all.
With interest rates being lower now, is there a break even? A lot of people tell me, if it's 2% less than what I pay now, then I should do it.
We do the math. Everybody's situation's different because, the larger the loan, the more you're going to save every month. So we look at that and we look at it from a total cash flow transaction. If you're going to skip a mortgage payment in the process, and we've got to put new money in a new escrow account for you, but you're going to get a refund of the old escrow account. So we look at all of that. And again, it's what fits somebody's needs. Somebody comes to me and they're cash strapped, but they still can qualify and we're still going to be able to save them $300 a month. We're going to roll it all in. We're not going to make life more difficult than it needs to be with asking them to come up with thousands of dollars to fund the new escrow or to do this. We're going to make that deal work for them and get them in a situation to be able to save money.
So I guess it's like someone walking out to me going, okay, how much do I need to have for retirement?
Right. Like, and if they say, okay, well, do you like ramen noodles for dinner, or
Right.
are you going to be going to the great new restaurant on the square and eating steak and lobster
Right.
every night?
Exactly. Every family is very different. We have families that live on $35,000 a year in retirement, and they're as happy as can be. And we have families that if they had less than 250, the sky would be falling. It's
I understand.
all. So is mortgage a little bit the same way?
I can usually determine that in a couple of conversations. And certainly by the time we get into, looking at customers' documentation and paperwork. But again, I get back to the fact that we always try to help them make a good choice, and not telling anybody or dictating,
right?
But to put the facts and figures on the table and help them understand them so that they can make the best choice.
So these low interest rates are really well for what we call conforming loans, correct? But we're seeing a little different market for the jumbo loans. Can we talk about the difference between what a conforming loan is and a jumbo loan?
Sure. I mentioned earlier how the government stepped in and created the pseudo market that we have. They're not, actually, they still are in receivership, conservatorship by the government. Fannie Mae, Freddie Mac, they buy the mortgages from those of us who make the mortgages and keep that money flowing in the marketplace. The maximum loan amount they will buy in our area is $510,400. And of course, that number's based on the median sale of a house on Tuesday afternoon at 3:00 in November. Or so, it's a statistical representation of an average, amount that is suitable for our demographics and our marketplace. The jumbo market, or the portfolio loan market, is not part of this. Fannie, Freddie, they don't participate in that marketplace. And so they're private investment loan. I mean, you've got money from wherever coming into those funds to fund those mortgages. And because they're bigger, because a lot of times, not every borrower fits the mold for a Fannie Mae, Freddie Mac. We've always called them vanilla loans. You got to fit in the shoebox. The interest rates and terms and conditions for portfolio loans, for private investment loans, are a little tighter than what we see. And sometimes not. They're
tighter,
still
more restrictive as far as household income or debt to income.
Debt to income ratios. But on the flip side, though, they still have the flexibility to basically make their own rules too. The guidelines and government regulation collide sometimes too. After the recession, there's a lot of consumer protection guidelines and everything that came into play, and that limited that marketplace for a while. But it was growing, and it's a strong segment. Now, don't know, the market has dried up. As you know, we have really weird movement of liquidity in different segments of the market,
for the jumbo
just like
market.
you do.
Yeah. Certainly we see homes selling. There seems to be a shortage in some areas where we see multiple bids still, even in this current environment.
Definitely.
Are you seeing more refis or more new home purchases?
We're inundated with refis right now. I mean, just because I think everybody, as they've had a little more free time on their hands have been able to think about that. I am right now this week, in the last 2 months, starting on my 9th cash out refi for a new swimming pool for a client.
That's true. I think about refi. My mind goes to lower interest rate and how fast can I pay it off. But I forgot about the $100,000 pool.
My Miss McGillicuddy wants a new pool, and she's truly, since probably the mid part of April, as things drug on. In the beginning we didn't really know where we were going to be, and I got a lot of like honey-do list type things, like, should I get a home equity line to do this? Should I get a cash out refi to do this? And my mental kind of line in the sand with that is about $30,000 roughly. I think because, again, home equity line's a short-term situation. But once you get on the north side of that much money, then it's a long time to recoup or to repay that. You'd be better to roll it into a permanent type loan and be able to pay it back over 15, 20, 30 years. So we've done a lot of that. But then after we did 5 swimming pool loans, it became kind of comical, and now we're up to 9.
The home improvement segment of our economy has done very well. even I was guilty of walking out to my house going, I had no idea that tree was hanging over my roof. I need to call a tree guy. And I call a tree guy, and it's like, I could be there in 4 weeks.
I know.
And I talked to him about it for a little while. He's like, yeah, I actually feel really guilty because my neighbors are in hospitality and they have nothing to do right now.
Exactly. And we tried to get some painting done at my house and ordered a ceiling fan that's on back order now. So,
right.
I guess we'll keep on trucking, but we're here for you if you need some money to make
home improvement,
it shine and make you happier while you can sit at home and look at it.
So, browsing through TV channels, I get celebrities telling me, probably not directed at me, but maybe our older client base, that they should have a reverse mortgage. I'd love to have your take on the reverse mortgage concept.
That's a pause. That was a deep breath. I'm never really going to criticize somebody's decision when they're in the heat of the moment trying to make a decision. I fortunately didn't have to deal with that topic with my parents or grandparents. My preference is for pre-retirement age borrowers to start looking at it before they are retiring and kind of come talk to you and make a plan. And, if they need to cash out some money now, knowing that they're going to retire in 5 years and want to keep their house, to do those. And I always remind everybody that borrowing against your house is not a taxable event. People come to me all the time and don't think that is impacted somehow. At that point, it's better to borrow against your house than to go cash in your IRA or to, come up with money that way. So we look at that.
Because the whole concept of reverse mortgage, because what you're talking about is, hey, let's get a traditional mortgage ahead of time, knowing that we're going to have a shortfall out here in the future. Where a reverse mortgage,
they're just monetizing their house.
But if you put an interest rate on that, on a reverse mortgage, it's very high.
It's high, and the fees are high.
Closer to 8%.
And let me tell you the horrifying thing. That I won't tell you yes, no. You'll figure out, I recently helped a lifelong friend whose father had gotten a reverse mortgage and failed to let anybody know. He retired from Lockheed, had good income. One of the other grandchildren had come to him and asked for some money or something. He felt inclined to do this and didn't share it with the rest of his family. That reverse mortgage was called within 30 days of his death, and they were not playing.
So they were trying to take the house and the equity with it.
The equity, precisely. And, this really, again, wasn't an issue 10 years ago when market values were soft. Nobody really wanted to foreclose on a house. Mm-hmm. Nobody wanted to be stuck. But this home was in a very desirable neighborhood here in the downtown Marietta area, and she was stuck. She was just her brother had passed away. She's protecting that asset for her niece and nephew and for her children. And she had to refinance her own home to come up with the cash to call off the wolves and to save that property. And so if I could say anything about elder planning and that's post-retirement planning and asset protection, is to communicate with the parties involved and to make sure that everybody knows what's going on and that you have a true exit plan if you have a reverse mortgage.
We've had one situation here where I couldn't get a plan solved. And so I started going down the reverse mortgage rabbit hole, and I was really shocked about
the fees
and how little money you actually get compared to the equity and the value of the home based on your age. So if you're in your 60s, you get a lot less than to say if you're in your 80s, right?
Well, it's an actuarial
yes, exactly.
thing.
Exactly. And the more I looked at it, it's like, this is not a good deal for anybody. And fortunately, in this situation, actually, I think it was last week, there was a situation change that we no longer need that reverse mortgage anymore. We never got it. It was just in our hip pocket.
Well, it's a painful conversation.
We were about 3 years away from it going, okay, we're still okay. But at some point, we're going to run out of cash and we're going to have to do something different.
It's not pleasant. I mean, it's not something you want to talk to your parents about, selling the family home.
Right.
But, the reality of it is, and if it doesn't matter, if they don't need to protect that asset or don't care, then maybe, it's worth talking about. But I would just, again, wrap it up and say, be careful.
Yeah.
And know the numbers very well.
I agree. You have to ask a lot of questions. We've had a series of events where people have come to us for advice and, basically kind of looking over the shoulder of another not fee only advisor. And it was being recommended reverse mortgage. And there's really no need for it. If you just moved some shells around, there was no need for it. And you can live in peace in your home that was paid off.
Well,
so,
I get back to the same thing. I mean, it's are you going to spend the time and put in the effort to give your client the best advice and help in solving the puzzle? Or are you going to take the easy way and say, yeah, because it looks good on the surface of things.
Right.
Right. And you dig a little deeper and it's
right.
not.
I heard from a real estate agent recently that the 55 plus communities, the real estate agents are really pushing them, saying you can get into this house.
You can buy a house with a reverse mortgage. You can acquire a house with a reverse mortgage.
Right.
So tell me that. You're putting your cash into it, but you're paying them to distribute your cash to them on a monthly basis.
Right.
Well, shouldn't they pay you to do that?
Exactly.
Yeah.
So we've covered, I feel like, the most basic or the big products that are out there. Is there anything specifically you'd want our listeners to know about the mortgage business that maybe they don't quite, they wouldn't quite understand? You mentioned something earlier, so I'll throw one out there is, you want to refi your house, you think, I'm going to call my bank because they have my mortgage. So we've already debunked that whole comment because they're just starting over too.
Correct. It's all new money, new everything, and same documentation. Sometimes they like to say that they can get you approved with less paperwork, but ultimately we are all checking the same boxes. And it gets back to the Fannie Mae, Freddie Mac scenario that people invested money in bond funds backed by the mortgages that we make.
Right.
And the people that are investing that money expect to get their money back and a return on that money. So guidelines and rules and regulations and all the things that we have to do to torture our clients to get them approved and get them to the closing table are based on the performance of loans in the past. So supposedly, theoretically, when we process loans and we make sure, everybody has a debt to income ratio under 45%, everybody documents their cash to close with a 2-month history on their bank statement. The commission salespeople have to have a 1 to 2 year history. All of these things are there not only to protect a borrower, to make sure that they're on stable footing to be able to afford and pay back this money, but to ensure that the investors who paid for their mortgage are going to get their money back. And again, the documentation process, that's the number one thing. I'm teaching some financial literacy classes over at Marietta High School and already trying to get the kids thinking about that, about how you maintain your records. The biggest thing, sign your name the same way every time you sign your name.
Right.
When you get your driver's license, make it match your social security card. These kind of things that can become, little speed bumps for us when we're processing paperwork or things that don't quite match up. So balancing a checkbook sounds very archaic, but at least having a basic understanding of what we're looking for on your bank statements and looking at the overall picture. I can crunch numbers all day long, every day for anybody, but you as a homeowner have to know what you're comfortable with. Some people are going to be fine with the 45% debt to income ratio. Some people are going to lie awake at night, shivering and screaming because they can't stand it.
Right.
And so it helps if you have an idea of what you want and where your comfort level is, even before we start our conversation, so that I can give you the best knowledge and options for what you want and we can get where you need to be.
You made a really good comment, which poses a question for me. Let's talk about small business owners for a minute. I'm a small business owner, and I feel like that people don't want to give me mortgages.
You should be cussing Corona and COVID right now.
So is the process for us harder now?
Oh, definitely. And just because of the pandemic and everything. Well, it's harder for everybody right now because we have to jump through extra hoops to make sure that people are still employed, are still working, that their income hasn't been affected or impacted. And they always want to hurt the self-employed borrowers. It seems like, we do joke about it, that I could have a client who gets a W-2 and a hourly wage at McDonald's is easier truly for us than a self-employed borrower, even if you have, lots of assets, but it's almost like you're punished. But we do it. That's our expertise. And my background, I was an underwriter for over 25 years and I have one step shy of being a CPA, and still I have to stay really on top of tax rules and the cash flow of businesses. I spent yesterday morning educating an underwriter on a cash flow analysis of a business, which we're having to do right now. If a borrower wants to take money out of their business for their cash to close, it becomes a huge issue. So for any of your self-employed borrowers out there that are thinking of it, take your money out ahead of time.
I was about to say that. My understanding was if I wanted to make a down payment, I need to get it out of my business and into my savings account for about 3 months prior to a contract. Is that
true? Or you can hire me as your mortgage broker, and I won't charge you $400 an hour like your CPA would. I had to convince this underwriter yesterday that my client could do that. Back in the glory days, an accountant would just do the courtesy
of writing the letter.
That says
too much liability now.
Yes, and the letter, used to say that it's okay for Mr. Smith to take money out of his business. It won't impair the operation of the business. Well, they won't say that anymore, or there's very few of them that will, and I ran into that this week and kind of had to do my own analysis. Of course, like any government regulation, the Fannie and Freddie guidelines say do a cash flow analysis to determine that the withdrawal of funds won't impair the business.
That's crazy.
Well, they don't say, we need a 2 times cash flow. They don't say. So we got it squared away. And she happily closed yesterday, and we'll move on. But it does. Those are the kind of things that I can't predict. And my client didn't tell me that up front. She had other funds, and we assumed up until last week that she was using other funds. And then when we discussed the ultimate end of it, no, she was doing this, that, and the other. And that does make things kind of challenging for us when our target is moved.
Well, I can certainly attest that you work hard in getting people from the starting point to the end. We certainly trust you with your guidance you've given us, even just looking at, hey, should we get a mortgage?
Right. A couple of folks, we've said no.
They said, no, that's not a good idea.
Right.
So, well, thank you for your time today. And we look forward to working with you as we move along in the future.
Thank you so much.
Well, I thought that was a great interview with Mary Ansley. She's certainly an expert in her field and understands mortgages. And we lean on her a lot when we're trying to make the decision of whether someone should refi or if someone should maybe even not have a mortgage at times. Sometimes it goes back and forth, but good conversation. Matthews, what did you get out of that?
Yeah, I thought it was very informative. I think just that there's a lot of options out there, whether it be just the mortgage or refi, and it helps to have a consultant there who's giving you the best options, a few lists of that, and then so you can make the best informed decision.
Yeah, I'd like to concur with what Matthews just said, that it's good to have somebody else knowledgeable and as much as an expert as she is, because quite often it's not unusual that a mortgage may be the largest financial transaction some people will ever make. And it's not a short-term transaction by any means. So it's good to have good consultation ahead of time to make sure that you're getting a mortgage that's right for you. And it sounds like she at WD Little can deliver that.
Absolutely. Well, enjoyed the podcast. Guys, I'll see you for the next one.
Thank you.
Thank you.
Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.